A lot of investors are afraid to invest outside of their own area. And one of the best parts about a syndication is these are typically larger deals that have on-site property management.
You're listening to Alternative Investor Mastermind, where we do a deep dive on alternative investment opportunities and the lifestyle it can create. Join Jack Krupey as he presents actionable tips and tricks in doing passive real estate away from mainstream strategies. Go beyond the usual fix and flips and try less explored yet rewarding investing ventures, from multifamily properties, mobile homes to cryptocurrencies. Do not miss this opportunity to escape traditional assets and finally create wealth without Wall Street. Now your host, Jack.
Hey everybody, welcome to another episode of the Alternative Investor Mastermind. Today we are going to talk about syndications. And with that, I want to start with what is a syndication. At the simplest level, a syndication is a partnership between a group of investors pooling their resources into a single investment. Private real estate funds are somewhat similar, and in some cases, the fund that I'm involved in is sometimes referred to as a fund of funds, but really it's a fund, primarily a fund of syndications. The majority of our investments are individual property deals where we raise capital through a private placement and we invest into apartment complexes. We do, on select situations, also invest in other funds which may own a number of apartment buildings or self-storage facilities. So why would investors want to invest in syndications? And what are some of the, I'm going to talk about some of the concerns and questions we've gotten over the years. So a lot of investors are afraid to invest outside of their own area. And one of the best parts about a syndication is these are typically larger deals that have on-site property management. And if you're going to invest outside your area, I'm a firm believer that it's better to invest into a larger deal with a professional team than to perhaps try to buy a single family house or a duplex hundreds of miles from your hometown. It's less likely to become a headache when you have a larger deal with a professional management team. Many people think that you have to do it yourself and you just have to be a landlord. And as someone who owned a number of properties in my 20s, it's very difficult to scale a single family real estate business. And a lot of people have done it successfully, and it's certainly not impossible, but if you're already a high-earning professional, if your goal is to generate passive income and work towards early retirement, becoming a landlord to a significant number of single-family houses it's not retirement in most cases. And in the worst case, it actually can create you a job that you may dislike more than your current job. Are REITs and syndications interchangeable? No, they're not. They're not quite apples and oranges, but I think there are many significant differences. So REITs are simply a tax structure where the entity itself is not taxed, and it just passes through at least 90% of their income to investors. The investors get taxed themselves. So REITs are typically larger, and a majority of the publicly traded REITs are investing in institutional quality assets, Class A, higher end apartments and office and industrial. There's a number of REITs that are going to have significant challenges, especially those in the office space market that bought office space at very low cap rates 3 to 5 years ago, and some of these have lost 50% or more of their value in recent years. So REITs are also, even though it's supposed to be a tax efficient structure, it's actually not tax efficient for high earning professionals. REITs actually end up getting taxed at 29.6% on the dividends. And syndications are private deals. They're generally done through a private placement, so they're not publicly traded. They do not have the liquidity. The one benefit of a publicly traded REIT is you can click a few buttons and you can sell if you want your money out. However, with syndications, your money is typically locked up for a period of 1 to 5 years, maybe up to 7 to 10 years. And, you're owning a piece of a private business at that point. So you will advise any potential investor that don't put money in that you're expecting to need to withdraw in 3 to 6 months, because you're in for the long haul on these deals. But with that said, there's a lot of tax efficiencies for syndications because the real estate depreciation actually passes through to investors. So if you put $100,000 into a REIT as an example and you received $8,000 in dividends, those dividends would get taxed. And if you're at the highest tax bracket, you're going to pay 29.6% taxes. That same $100,000 in a syndication, if it generates $8,000 in income in the first year, more than likely you're actually still going to show a loss on paper, because that syndication is likely to generate through depreciation perhaps $50,000 to $75,000 in a paper loss via K1. So you'll have $8,000 cash in your pocket, but on your taxes you're still showing a loss on paper. So you're earning tax deferred income versus paying 29.6%. We've received a lot of questions about how to get started, and is it better to build up with smaller deals? And again, it goes back to, what are your goals? If your goal is to generate passive income, slow down, get out of the corporate rat race, then starting in syndications is a better path to passive income. Owning a number of small rental properties is rarely passive. When you're getting the phone calls yourself for repairs, when you don't have the scale to have the attention of maintenance people, it becomes a job, and it's tough to be efficient. Think about if you have 2 rental units and you need a plumber, how are you going to get their attention? You're probably going to call Roto-Rooter, and you're probably going to pay retail, and it can eat up your profits significantly when minor repairs have to go to sort of a retail retail type of plumber or contractor. Whereas if you have a 100-unit building, you typically have a full-time maintenance person on staff, and a majority of those small jobs will get taken care of without you as owner even really knowing about it or seeing a bill, because your maintenance guy is on payroll. So how do you know you're not going to get scammed? Been a lot of high-profile issues over the years, even as crazy as like a Bernie Madoff, who was the former chair of the SEC and was running the largest Ponzi scheme. And the good news is with syndications is, although they're not publicly traded, there is a fair amount of filings and regulations. In order to do a private placement, you do need to register a Form D with the SEC. There's a significant amount of disclosures and paperwork involved. And working with a group like ours that has a track record of investing in 40 or 50 deals takes a lot of the risk away of potentially being scammed. We would advise work with investors that you have references, and or join mastermind groups where you can meet other investors that may have worked with a specific sponsor. And it's obviously something everyone should be concerned about, but I think what we found is once you're in the business, in the industry, in the club, if you will, there's a great majority of sponsors and operators that have a really strong track record, of really strong ethics, hundreds of happy investors, and very transparent with reporting as well. And with that said, we've talked to a number of investors who just have a real difficulty giving up control. somebody who's been a do-it-yourselfer for most of your life and career. And the thing I'll say is, when you get into these larger deals, there's often someone who's got to do it better than you will. And I learned that early on. Myself, I loathe getting into kind of the property management, tenants and toilets, micromanagement of a business. So, I sought out early on to, partner with really good operators that ultimately are going to do a better job than I would at property management, because it's their personality type. And the great thing about this business is some of the best property managers are actually not good marketers, and they actually love to partner with groups like JCAM to invest with, because they're really good at what they do, but at the same time, they'd rather be on site at the property, improving it and making money than talking to investors all day. Whereas, myself and my team, I love nothing more than talking shop with investors on how to, generate passive wealth, how to be tax efficient, and how to find really good real estate opportunities. So it is a true win-win. So that's about it for this episode. I'd encourage everyone to please like and subscribe on our YouTube channel. Leave us a 5-star review if you like what you're hearing on iTunes, Spotify, or your platform of choice. And we'll catch you on the next episode.
That's all for this episode of Alternative Investor Mastermind. Now that you know the many alternative opportunities out there all up for the taking, you can finally become ultra connected and ultra wealthy. Get more valuable advice from the experts by subscribing to the show at alternativeinvestormastermind.com. Become a winner in the world of passive investing today in alternative investment strategies. Thank you for joining us. Until next time.